Listen carefully. What I am about to tell you could change everything you think you know about money in 2026. Right now, as you're watching this, the financial world is holding its breath. The markets are closed. Trading screens sit dark. Silver is frozen at $71.47. But don't let this silence fool you. Beneath the surface, something massive is building. In just a few hours, when the electronic futures market reopens at 6 p.m. Eastern Time, we're going to witness capital flooding into the market like we've never seen before. And I'm going to show you exactly why this matters to you. Before we dive deeper, do me a favor. If you want to stay ahead of the financial curve and understand what's really happening with your money, hit that subscribe button and turn on notifications. Trust me, you'll want to see what's coming next. And if you find value in what I'm sharing today, drop a comment below. Tell me, are you watching what's happening with silver? Your engagement helps us reach more people who need this information. Now, let me explain something most people don't understand. We're not just starting another trading day, we're starting a completely new trading year. And in the world of big money, institutional finance, the first week of January is unlike any other week on the calendar. There's a phenomenon called the January effect, and it's about to shake everything up. Here's what's happening. Hundreds of billions of dollars from pension funds, insurance companies, and hedge funds are required to enter the market right now to rebalance their portfolios. This isn't optional, it's mandatory. Their computer models are screaming at them to buy the best performing asset of last year, and that asset is silver. But here's the problem that's about to send shockwaves through the system. There's no silver available to buy. The vaults are running empty, dealers are sold out, miners are holding onto their supply. So when $50 billion of institutional money tries to enter this market tonight, it's going to hit a wall of scarcity. Let me break down why this moment is so critical. You need to understand how Wall Street actually works. Regular retail investors, everyday people, they trade on emotion. They buy when they're excited, sell when they're scared. But institutional investors operate on a completely different system. They trade based on dates and schedules. December 31st marks the end of the fiscal year. Until midnight last night, the entire game was defensive. Fund managers were selling their winning positions to lock in their bonuses. Banks were dumping assets to improve their risk scores. Taxpayers were selling losers to harvest tax deductions. All of December was controlled by selling pressure. But the moment the calendar flipped to January 1st, everything changed. The game switched to offense. The tax year is over. That selling pressure vanished overnight. Now the new allocations kick in. Every major fund has target allocations for the new year. They're required to own certain percentages of commodities, gold, and other assets. Right now, many of them own 0% in these categories. So they have to go from 0 to 5% or more, and they have to do it fast. Most funds execute these massive orders within the first 5 trading days of January. This creates an artificial tsunami of buying demand that has nothing to do with news headlines and everything to do with portfolio requirements. It's a wall of money hitting the market all at once. And this year, that tsunami is bigger than it's ever been. Why? Because in 2025, bonds collapsed and stocks were volatile. Silver was one of the few things that actually worked. So the algorithmic models that tell institutional investors what to buy are all pointing to the same thing, silver. They're mandated to buy it. They have no choice. Let me put some real numbers on this so you understand the magnitude. The global pension and endowment market manages roughly $50 trillion. Historically, they mostly ignored commodities. But with inflation staying above 5%, they're panicking. They're shifting money out of the traditional 60-40 stock and bond split into alternatives like precious metals. If the global pension system decides to move just 0.1% of their assets into silver, that's $50 billion of new buying pressure flooding in. Now look at the other side of this equation. The entire annual mine production of silver on the planet is about 800 million ounces. At $71 per ounce, that's worth roughly $56 billion. Do you see the mathematical problem here? Pension funds want to buy almost the entire annual supply of the planet in the first week of January. It simply doesn't fit. You cannot buy $50 billion worth of silver at $71 an ounce. There isn't enough physical metal available. So what happens when demand vastly exceeds supply? The price has to act as the rationing mechanism. The price has to rise until that $50 billion buys a smaller amount of metal. If silver doubles to $140, that $50 billion only buys half the annual supply. If it goes to $280, it buys a quarter. The price must rise to accommodate the capital trying to enter. This isn't speculation or theory. This is basic supply and demand dynamics. When you pour a gallon of water into a shot glass, it overflows. Tonight, the water starts pouring. The first sign of this wave is going to happen tonight, Thursday at 6 p.m. New York time, when the Globex electronic markets open. This is where algorithms trade while human floor traders are sleeping. Usually holiday sessions are quiet, but tonight is different. While New York was closed for the holiday, Markets in Shanghai were still operating and still hungry for silver. The gap between US prices and China prices is still there. Tonight, when the arbitrage algorithms turn on, they're going to see that gap. They're going to see cheaper silver in New York, and they're going to hit the buy button hard. This could create a gap up right at the open. We could see silver jump from $71.47 to $73 in the first minute of trading. If this happens, it sets the psychological tone for Friday's full trading session. It signals to human traders that the dip is over and buying has started. It creates urgency. Anyone waiting for lower prices will realize they missed the bottom and they'll panic buy. This fear of missing out adds fuel to the fire the algorithms already started. Now let's talk about the banks, because this is where it gets really interesting. Yesterday, regulatory requirements, called the GSIB surcharge, forced banks to sell silver to clean up their balance sheets for the year-end snapshot. They pushed the price down to $70.50. They achieved their goal. They lowered their risk scores and protected their bonuses. But now the snapshot is over. The regulators took their picture and left the room. The banks are free to trade again. And what do banks do when they're free to trade? They trade to make money. They know the institutional flow is coming. They know pension funds are buying on Friday. So do you think these banks are going to stay on the short side? Absolutely not. They're going to front run their own clients. JP Morgan knows that major pension funds are going to buy silver tomorrow. So JP Morgan buys silver tonight at $72, then sells it to those pension funds tomorrow at $75. They scalp the market for profit. This means the banks, which were the biggest sellers throughout 2025, are likely to become the biggest buyers in the first 48 hours of 2026. They're flipping the switch. The suppressors become the squeezers because they want to ride the wave up before they potentially short it again later. This aligns all the major forces in the market on the same side. Eastern markets are buying, pension funds are buying, banks are buying. So who's selling? Nobody. Miners are holding their production. Dealers are out of stock. Retail investors are holding tight. This is the perfect recipe for a vertical price move. If you're finding this valuable so far, please hit that like button and leave a comment. Tell me what you think is going to happen with silver this month. And make sure you share this video with anyone who needs to understand what's coming. The algorithm rewards engagement, and it helps us reach more people with this critical information. Now, while all this paper money is lining up, what about the physical metal itself? While markets were closed today, the physical shortage didn't take a holiday. Factories in China are still running. Mines in Mexico are still depleting their reserves. We need to look at the physical disconnect as we enter this new year. Because what's happening on Main Street tells a completely different story than what the paper markets are showing. If you're looking at the chart right now, you see $71.47 flashing on screens in Tokyo, London, and New York. That's the number algorithms use to value billions of dollars of derivatives. But I need to tell you something the banking establishment won't admit. That price is essentially fiction. It's a phantom price. It's the price of a digital contract that was traded during a holiday week with thin volume and limited participation. If you try to take that 71.47 number into the real world and actually exchange it for an ounce of physical silver, you're going to get a very different reality. The paper market is living in a fantasy land. The physical market is living in a supply crisis. Well, let me show you the massive disconnect between what the screen shows and what the street actually experiences. Over the last 48 hours, something remarkable happened at bullion dealers across the country. While hedge funds were selling paper contracts to manage their tax situations, the retail public was storming coin shops. We've received reports from major online bullion dealers in the United States and Europe reporting a complete blowout of inventory. Usually the week between Christmas and New Year is quiet, but this year, sales volume was up 300% compared to last year. Why? Because the public senses something is wrong. They saw the volatility. They saw headlines about debt. They saw the crash and recovery, and they decided to take physical possession of real metal. But here's the critical problem. The dealers cannot restock their inventory. The sovereign mints, the US Mint, the Royal Canadian Mint, they're closed for holidays. Wholesalers are running on skeleton crews. Every ounce that was purchased this week is an ounce that cannot be replaced until mid-January. The shelves are bare. So what did dealers do? Did they lower their prices to match the spot market drop? No, they raised their prices. If you look at the premium on a Silver Eagle right now, it's approaching $20 over spot. The asking price is over $90 per coin. This is the market telling you the truth that the paper market is hiding. The spot price says silver is abundant. The premium says silver is becoming extinct. This divergence is one of the most reliable signals in commodity markets. When the paper price drops, but the physical price rises, it means the paper market is broken. It means short sellers are trying to suppress a beach ball that's fighting to surface. And when the paper market finally breaks, it doesn't gradually adjust. It snaps up violently to meet the physical price. It doesn't meet in the middle, it gaps up dramatically. Now let's look at the industrial users, the whales of the physical world. We talked about the January effect for pension funds, but there's also a January effect for industry. It's called procurement season. In January, companies like Samsung, Tesla, and First Solar negotiate their annual supply contracts. They sit down with refiners and miners to lock in their price and volume for the entire year. Usually, this is a routine meeting. We need 10 tons. Here's our price. Deal done. But this year, these meetings are turning into panic rooms. Refiners are telling industrial giants something shocking. We don't have enough metal. The mines are depleting. The Chinese are hoarding. Recycling is failing. We can only give you 70% of what you need. Imagine you're the CEO of a solar company. You have a mandate to double production in 2026, and your supplier tells you they're cutting your silver allocation by 30%. What do? You panic. You go into the spot market and buy everything that isn't nailed down. You pay any price necessary. $75? Fine. $80? Fine. You just need the metal to keep your factory operational. This is happening right now as we speak. While markets are closed, procurement teams are making urgent phone calls. They're engaging in off-market transactions. They're buying silver directly from vaults in London and Zurich, bypassing the exchanges entirely. This removes visible inventory from the official exchange warehouses. When trading opens tomorrow, traders will look at warehouse reports and wonder where all the silver went. It went to solar farms in Arizona and manufacturing plants in California, and it's never coming back to the market. We cannot discuss physical silver without talking about China. While New York sleeps, Shanghai is actively consuming. The price in China is still trading at a massive premium to the West. We're looking at a gap of nearly $5 per ounce. And today, January 1st, China implemented new silver export controls. They're locking their doors while Wall Street is still trying to find the keys. This arbitrage situation is the engine driving the shortage. Every day that New York trades lower than Shanghai, a fleet of cargo planes takes off from JFK and Heathrow carrying silver bars eastward. This isn't conspiracy theory, it's simple, profitable math. If you can buy something for $500 in New York and sell it for $600 in Shanghai, you buy every unit available in New York. That's exactly what's happening to silver bars. The West is being systematically drained of its strategic reserves. We're selling our resource heritage for paper dollars, and China is happily accumulating it. They understand that in 2026, the paper game eventually ends. They want to be holding the physical assets when the music stops. And this constant flow of metal eastward creates a floor under the price. The price cannot drop below the level where arbitrage becomes profitable. Right now, that floor is around $71. If silver drops below that level, Chinese buyers back up the truck. They act as the buyer of last resort, which limits downside risk. Some skeptics argue that if the price rises to $70 or $80 or $100, miners will simply dig more silver. But that's not how mining actually works. It takes approximately 10 years to open a new major silver mine. Even at $100 per ounce, you cannot speed up the geology, you cannot speed up the environmental permits, you cannot speed up the construction timeline. In fact, supply might actually decrease in 2026. Why? Because of political risk. Look at what's happening in Mexico and Peru, major silver producing nations. The governments there are looking at $70 silver and getting greedy. They're talking about higher mining taxes. They're discussing nationalization of resources. When governments attack miners with hostile policies, miners stop investing. They stop exploration. They reduce operations. Some go on strike. So precisely when the world needs more silver production, the political environment is ensuring we get less. This is the definition of a structural deficit. It cannot be fixed by price alone. It requires a decade of stable investment and political cooperation. We have neither right now. Industrial buyers know that no cavalry is coming from the mines. Retail buyers know that no help is coming from the mints. The only source of silver is from existing stockpiles in vaults, and those vaults are running on fumes. Now we need to zoom out and look at the bigger picture, because silver doesn't exist in a vacuum. It exists in a world drowning in $36 trillion of United States debt. It exists in a world where the bond market is rebelling against central bank policies. It exists in a world where the full faith and credit of the financial empire is being questioned for the first time in 80 years. We need to examine the macro storm that is about to make landfall in the first quarter of 2026. I'm going to explain why the upcoming debt ceiling crisis in Washington is the trigger event that could send commodities into the stratosphere. We're going to analyze the bond market dynamics that are forcing the Federal Reserve's hand. And I'm going to show you why silver is no longer just an industrial metal. It's becoming a currency lifeboat. While you're celebrating the new year, politicians in Washington are preparing for another debt ceiling fight. In February of 2026, the United States hits the debt ceiling again. We've seen this political theater before. They fight, threaten default, shut down parts of the government, then ultimately raise the limit. but this time carries different weight because the interest on the debt has exploded. The US government is now paying over $1 trillion annually just in interest payments. That's more than the defense budget. That's more than Medicare spending. It's mathematically unsustainable. When the debt ceiling fight begins next month, markets are going to panic. Credit rating agencies like Fitch and Moody's will threaten to downgrade US credit ratings again. Foreign nations will hesitate to buy treasury bonds because they're scared of technical default. This creates a crisis of confidence in the system. When investors lose confidence in the supposedly risk-free asset, US government bonds, where do they turn? They move to assets with no counterparty risk, gold and silver. During the last debt ceiling crisis, gold rallied significantly. This time, with silver already in shortage conditions, the rally could be amplified dramatically. Silver is acting like insurance against government dysfunction. As the probability of political chaos rises, the price of silver tends to rise with it. You're essentially holding a hedge against political incompetence. We need to talk about the bond market because it controls everything in finance. Right now, the bond market is screaming warnings. Yields are rising. Bond vigilantes, sophisticated investors who sell bonds to punish reckless government policies, are actively selling treasury bonds. Why? Because they know inflation is not the official 2%. They know it's closer to 5% or higher in real terms. Why does this matter for silver? Because higher bond yields break the banking system. We witnessed this in 2023 with Silicon Valley Bank's collapse. Banks hold bonds as collateral on their balance sheets. When bond prices crash, which happens when yields rise, banks become insolvent. If yields spike sharply in January, we could see another banking crisis unfold. Maybe a regional bank fails. Maybe a larger bank wobbles. And what does the Federal Reserve do when banks start failing? They pivot. They stop fighting inflation aggressively. They stop raising interest rates. They turn on the metaphorical money printer. They create emergency liquidity facilities. They flood the system with fresh dollars to save failing institutions. This is what's called the Fed put. Every time the system breaks, they print money to stabilize it. And every time they print money, the value of each dollar falls and the price of silver rises. We are essentially waiting for the system to break enough that the Fed has no choice but to inflate. While the West struggles with insurmountable debt, the East is building an alternative system. The BRICS alliance, Brazil, Russia, India, China, South Africa, and new member nations, is actively moving away from dollar dependency. They call it de-dollarization. In 2026, we expect major announcements regarding a BRICS trade settlement system, potentially a currency backed not by promises, but by hard assets like gold, oil, rare earths, and yes, silver. China understands that to challenge dollar dominance, they need currency with intrinsic value. Paper money has been a weapon wielded by the United States. Commodity-backed money becomes the shield used by BRICS nations. If silver becomes a component of a new global monetary reserve system, it remonetizes instantly. For 40 years, silver has traded primarily as an industrial commodity like copper. If it becomes recognized as money again, the entire valuation model changes. Money trades at a significant premium to its industrial value. Gold trades at a massive premium specifically because it's recognized as money. Silver is currently trading primarily at its industrial value. The monetary premium represents enormous upside potential, and BRICS nations might be the catalyst that applies that premium. Financial analysts love discussing real interest rates. Traditional theory says if interest rates are high, gold and silver should fall because they pay no yield or dividend. That's the textbook theory. But look at actual reality. Interest rates are around 5%, yet silver is at $75. The textbook is broken. Why? Because the market knows the stated interest rate is misleading. The real interest rate is the stated rate minus actual inflation. If the bank pays you 5%, but your cost of living increases 10%, your real rate is negative 5%. You're losing purchasing power by holding cash in the bank. Smart money understands this. They know the official CPI inflation numbers are manipulated lower. They know true inflation is double digits for most real expenses. So gold and silver are rising even with high interest rates. This is a historic anomaly. It usually only happens during currency collapse scenarios. When markets stop believing the central bank has control, the rules of traditional economics invert. We're living in that inversion right now. Finally, let's examine the second wave of inflation. The Federal Reserve claimed victory over inflation. They said it was coming down, problem solved. But look at the underlying inputs. Oil prices are rising, shipping costs are rising, labor costs continue rising, insurance costs are skyrocketing. Inflation is proving to be sticky and persistent. In the 1970s, inflation came in three distinct waves. The first wave hit, the Fed raised rates aggressively, inflation fell temporarily, everyone celebrated victory. Then the second wave hit harder, then the third wave hit hardest of all. We just finished wave one. Wave 2 is building in the background. When inflation numbers start creeping back up in 2026, markets will realize the Fed is essentially powerless. They cannot raise rates much more because it would bankrupt the US government through interest payments, so they have to let inflation run hot. This is called financial repression. In a world of structural persistent inflation, you need assets that cannot be debased or printed. Silver is arguably the ultimate inflation hedge because it's also an industrial necessity. It protects you from the money printing press while also benefiting from economic growth and industrial demand. It's one of the few assets that wins on both sides of the equation. So we have the perfect macro storm gathering. The debt is mathematically unpayable. Bonds are crashing. Inflation is returning. And the physical silver market sits empty. What happens when you throw a match into a room filled with dynamite? You get an explosion. But analysis without execution is useless. We've reached the point where theory meets reality. We've dissected the $50 billion wall of capital about to hit the market. We've exposed the physical dealer blackout and industrial panic. We've analyzed the macro, superstorm of debt and monetary crisis. Now the analysis phase stops and execution begins. Tonight, the electronic markets open. Tomorrow morning, the opening bell of 2026 rings. You have the information. You understand the why. Now you need the how. Let me give you the execution strategy for this first critical week of January. Looking at the chart one final time before candles start moving, we're sitting at $71.47, resting on massive technical support. What are the price targets for the first week? Target 1 is $75. This represents the previous high and the breakout point. If pension funds enter aggressively on Friday as expected, we should clear $75 within the first 48 hours of trading. If we break 75 on high volume, it confirms the correction is over and the green light turns on. Target 2 is $83. This is the wick high from the previous Monday squeeze. Technically, price loves to revisit these levels. The market wants to test that zone again to see if sellers are still present. I believe we'll challenge $83 before the end of January. If we clear 83, we're in blue sky territory with limited resistance above. Target 3 is triple digits, $100. This is the quarterly target. If shortages are as real as premiums suggest, and if bond market volatility continues, there's no major structural resistance between 83 and $100. It's a vacuum zone. The price could move from 80 to 100 faster than it moved from 20 to 30. So don't be surprised by parabolic moves in Q1. Be prepared for them. Now I need to have a serious conversation with you about something most people get wrong. Buying is easy, selling is hard. Most investors ride a bull market all the way up, fall in love with the asset, become emotional cultists, then ride it all the way back down. You're not a cultist, you're an investor. The goal is increasing purchasing power and building wealth. So when do you sell? You don't sell for dollars. Dollars are part of the problem. You sell for gold, productive land, or income-producing assets. Use the gold to silver ratio as your GPS navigation system. Right now, the ratio is roughly 60 to 1, meaning 1 ounce of gold buys 60 ounces of silver. Historically, this is still relatively cheap for silver. In bull markets, this ratio compresses. When the ratio hits 40 to 1, pay close attention. The easy money phase has been made. When it hits 30 to 1, start scaling out. Trade 20% of your silver position for gold. You're moving from high risk to lower risk assets while locking in gains. When the ratio hits 15 to 1, consider exiting completely. Swap remaining silver for gold, or buy productive assets like a farm or apartment building. Move from speculation to generational wealth preservation. If you follow this disciplined plan, you don't obsess over dollar prices. You don't care if silver is $500 or $5,000. You only care about its value relative to other real assets. Write this ratio down, tape it to your computer. 15 to 1. That's your finish line. We're about to potentially enter a mania phase. A mania is different from a normal bull market. In bull markets, people are optimistic and rational. In manias, people become irrational and emotional. You're going to see friends and family, the same ones who laughed at you, suddenly asking how to buy silver. You're going to see content creators who normally discuss gaming or makeup suddenly talking about precious metals. This is the classic shoeshine boy indicator. When this happens, you'll feel like a genius. Your ego will inflate. You'll think you can do no wrong. That's the moment of maximum danger. That's when you'll be tempted to use leverage, to borrow money against your house, to buy more. Do not do it. When mania hits, your job is being the adult in the room. Keep your head clear. Stick to your plan. Don't get greedy at the top. You bought near the bottom. You've already won. Your job now is simply landing the plane safely. Also prepare yourself for volatility. In mania phases, silver can drop 20% in a single day and still remain in an overall uptrend. If you're leveraged, that volatility destroys you. If you own physical metal, you just blink and hold. Stay unleveraged. Stay physical. Stay sane. Here's your checklist for market open tomorrow. 1. Watch the Globex open tonight. Does it gap up? If yes, demand is immediate and real. If it gaps down, it might be a final shakeout trap. 2. Watch volume on Friday morning. We want to see high volume indicating pension funds stepping in. If price rises on low volume, be suspicious. If price rises on massive volume, it's the real deal. 3. Keep watching the dealers. Do sold out signs disappear or do they persist? If dealers remain sold out next week, the squeeze is going vertical. 4. Watch mainstream media coverage. Are they ignoring it? Good, we're still early. Are they screaming about it? Be careful, we're getting late and popular. Here's my final verdict. 2025 was the warm-up act. 2026 is the main event. We have the perfect storm converging. Industrial scarcity, monetary collapse, geopolitical conflict, and institutional fear of missing out. There's no force on earth strong enough to stop this trend once it fully starts. Banks tried to control it and failed. Governments tried to manipulate it and failed. Now the market takes over. You've done the work. You've prepared. You've educated yourself. Now all you have to do is watch it unfold. This could be the year you've been waiting for. This could be the year silver reclaims its historical role. Before we wrap up, I want to hear from you. What's your strategy for 2026? Are you positioned in silver? Drop your thoughts in the comments below. And if you found this valuable, please share this video with anyone who needs to understand what's happening. Hit that subscribe button if you haven't already, because we're going to be covering every major development as this situation unfolds. Turn on notifications so you don't miss critical updates. Remember, this is Money Aftermath, where we cut through the noise and show you what's really happening with your money. The countdown has started. The capital is queued up. The markets reopen in hours. This is the beginning of the January squeeze, and you're now prepared for what comes next. Stay sharp, stay informed, and I'll see you on the other side of the opening bell.